Hi, this is Julia Guth, CEO and Executive Publisher of the Oxford Club. Thank you for joining me today. I'm coming to you from our clubhouse in Baltimore. It's very quiet here right now, but this has been my second home for over 30 years. I'm bringing today to you 3 of our top experts in the club. Let me introduce them to you now. First, we have our Chief Investment Strategist, Mr. Alexander Green. Hi, Alec.
Hey, Julia, how you doing?
It's a loaded question, but I'm so happy to have you.
Baby, go on.
Yeah, I'm happy to have you here and our other special guests because I want to tell the members they're in such great hands with our investment team. And so let me introduce you a little bit. I mean, you are a 3-time best-selling author. You have actually worked with me for 20 years now through several financial crises, including 9/11 and 2008. Each time we've come out ahead successfully. You know, I applaud the way that you've guided our members with focus and your calmness. And so you're really the captain of our ship. And so I'm really happy to have you here today. Thank you.
Thank you, Julia.
Okay. Our next special guest is our Chief Income Strategist and also an expert in biotech, in the biotech sector. His name is Mr. Marc Lichtenfeld. He's also in charge of what is one of the largest financial e-letters in our industry, wealthyretirement.com. And again, a stellar track record and somebody who is going to be able to talk to us all about what dividend-paying stocks they should be looking for, how do they orient their income, including bonds, as well as talk about some of his expertise within the healthcare industry and biotech industry. So welcome, Marc.
Hi, Julia.
Thanks. And our third special guest is also another chief here at the clubhouse. His name is Mr. Matthew Carr. He's our chief trends specialist, especially with emerging trends. And Matt's been working with me also for a very long time here in Baltimore. I admire that he also comes from the energy sector before he came to the club. So given what's happening with that sector now, I'll be asking him some questions about energy stocks, as well as just really has a keen eye looking at emerging trends and how to capitalize on emerging trends before they happen. He's an award-winning analyst here with his track record. Welcome, Matt.
Hey, thanks for having me, Julia.
We're going to get to the club's outlook on this coronavirus, and we're going to get to some member questions too, for those of you that wrote in with your questions. But right now, I really want to address the main reason that I'm having this event, and that is, how do we help our members limit their losses now and position themselves for success? I mean, is this really becoming the buying opportunity of a lifetime? Or should our members sit on the sidelines, build up their cash, and just wait with patience? It seems like, from reading your communications right now, you all are still buying. So let's talk about what you're buying and why. Alec, I'll start with you. Let's step back a bit and let's just talk about our pillars of wealth system, why we talk about having an exit strategy at all times, why it's never more important than now, using trailing stops perhaps, and what's happening since we're stopping out of a lot of positions. Can you explain why we use this principle of cutting your losses and letting your winners run?
Yeah, I'd be happy to. It is a key part of what we do, but I'd actually like to start at an even earlier place, which is the stock portfolio. The Oxford trading portfolio is just one part of our overall strategy. It starts with an asset allocation. I think you probably heard me talk about this so many times within the communique. You should have a portion of your money in stocks and a portion of your money outside the stock market in high yield bonds, high grade bonds, and in inflation adjusted treasuries. That all sounds boring when the market's going up, but in times like now, we realize the importance of diversifying not only within the market, but diversifying outside the market. So that's a key component of what we do. But then when you get to the actual Oxford trading portfolio, we have very strict criteria for what we buy. In other words, we're looking at certain sales growth, certain earnings growth, high returns on equity, quality of management, new products and services, all sorts of important data that goes into making the recommendation. And once we own it, we also follow a very strict sell discipline because we want to ride things up as far as we reasonably can. and we want to make sure that we don't lose those profits if the market turns down, or if we've recently bought something the market goes against us. We never want to let a small loss become an unacceptable loss. And within the Oxford trading portfolio, for instance, we've been stopped out of about a dozen stocks recently. And some of them we took our maximum 25% loss, but on other ones, like Rio Tinto, we more than doubled our money. On Diageo, we more than tripled our money. And so when you blend them all together, blend the losses and the gains together, you see that we've actually made money on most of our positions. Well, the average position has made money in a very tough market. So I do feel a bit bad for the people who only just joined the Oxford Club in the last few months, because all they got was the slide without the climb that preceded it. But that's just how it works. Sometimes it's 2 steps back before it's 1 step forward. So the idea of using trailing stops is you never know when something's going to happen, some bolt out of the blue, like this coronavirus, is going to upset things. And since you can't know, you have to use a system that allows you to protect your profits in the good times and protect your capital in the bad times. And so we have been stopped out of a lot of positions. That's not unusual. As you mentioned, we've seen it happen before in 2008 and 2009. Obviously, we're stopping out of various stocks because some companies just run into tough times along the way, and we either take profits or cut losses. But it's happened many times before, and it's okay. You're now sitting on a lot of cash. We're not going to be in a big rush to put it all back to work. We're going to gradually rebuild this portfolio. We'll buy back some of the stocks that we were in if we think the fundamentals are still sound, and we'll diversify into other positions as well. But we're sticking to a discipline that we've known all along: what we're going to buy, why we're going to buy it, and when we were going to sell it. And so the key right now is to stick to that discipline.
Okay, thank you. Marc, do you apply trailing stops to all your portfolio positions?
All except one, which is the compound income portfolio, which is focused on reinvesting dividends. And the reason for that is, and as I wrote in my book, Get Rich with Dividends, a bear market can be your best friend if you're reinvesting the dividends. And what I mean by that is, if these stocks come down, and it's not because of a reason that has to do with the company, so it's not that sales are down or their margins are shrinking. It's something like we're seeing now where the whole market slides. If you have a company that's still healthy and is going to have the cash flow to be able to continue to pay and raise their dividend, well, then if the stock tanks, then I want to be continuing to reinvest those dividends at a much lower price, because that's going to buy me a lot more shares, which is going to generate a lot more dividends, and buy more shares, generate more dividends, et cetera. And so it's really, the way I describe it, it really allows you to step on the gas of the compounding machine, which is the whole goal of reinvesting your dividends over the long term. But for all the other portfolios, I do use the trailing stop.
Matt, members are undoubtedly sitting on a lot more cash now, and I see that you are recommending buying more shares in different stocks. You mentioned something called Boson, a Chinese e-commerce company. Are you buying cheap, or would you call that value investing? And what does that mean, value investing, to you?
Well, so I consider myself more of like a crisis investor, than, or buying shares of companies that are been deeply cut over a very short period of time. So I don't know if that makes me a value investor. I do look for companies, though, that if their shares have fallen sharply just in a very short period of time, that they are priced better than their peers. That's always the first thing I'm looking for. I'm looking for the best in class price to sales ratio, price to book, things like that. Now, the things that I do think are interesting out there right now in this sell-off is you are seeing parts of the sector rebound. China was the first country to deal with the COVID-19. They are now reporting 0 cases. They're on a rebound, and these Chinese e-commerce stocks are actually starting to look really attractive. We do know that brick and mortar retailers are going to suffer, and that they are suffering, that there are shortages. But what these Chinese e-commerce companies are showing is that there is this resiliency there, that they are able to hold up and stand up in this environment. And in fact, you have seen some of these companies just over the past few days actually hit new 52-week highs. So that to me is a very interesting opportunity. That's what I'm looking for. They've come down, they were hit first, they took their whack, but now they're starting to look really attractive. And we're getting into those months where I like to actually buy them. But I mean, that's just one of the sectors that I think looks good right now. We talk about, Meal kits, Blue Apron. That went up 1,000% this past week.
Thank you. Alec, I want to get back to your comment about having an asset allocation, sticking with our asset allocation principle. So if you're stopping out of stocks and you're building up all this cash, like how do you then reemploy that back into the asset allocation? Are you saying there should be more allocation to cash until there's opportunity, or are you saying you want to put the money back to work right away?
Yeah, there actually really is not cash in our asset allocation model, but I'm sure that all of our members are sitting on cash if they've been stopped out of these various positions. And I just, it would be irresponsible of me to just say, okay, now plow it all into these 10 companies. I want people to take their time. This is a genuine crisis. I don't use the term crisis loosely, but what's happened is a health crisis, it's an economic crisis, it's a financial crisis, and you don't have to be the first one to the fire to take advantage of a crisis. And so our members really need to stop and think about the fact that we have their best interests at heart, and we're going to tell them to put this money back to work. We're definitely going to reinvest this money. We are not going to sit on cash for a long time. We are not going to run to bonds or gold or do something completely nutty and different. We're going to do what is proven to make money, not just year after year, but decade after decade, and that is to buy growing, profitable companies that will be here on the other side of this crisis, making money again, paying dividends again, and generating good returns. But we're going to do it carefully and calmly and over a period of weeks, not all at once. So I can see how if you've been stopped out of 10 positions in the last 2 weeks, you're ready to put that money back to work because things are very cheap right now. However, it's going to be volatile for a while. I mean, investor psychology has been scarred. Everyone around the world is trying to get a grip on just how bad the virus is going to be, what the economic impact is going to be, which businesses are going to be adversely affected, which ones will be hardly affected at all. For instance, utilities and drug stocks and healthcare companies and defense contractors and online retailers and so on, they really are not going to be hurt much at all by this. And yet some of them have seen their shares knocked down substantially. So we're going to be concentrating on opportunities like that, as well as looking at some bombed out sectors in energy and elsewhere that also have good potential. So I don't want them to think that we've moved into cash and that's where we're going to be sitting for months, because it's not going to happen. We got stopped out of virtually everything in 2008. In fact, I don't want to say virtually. Julia, you know that all of our members can go on our website and go back and look at our past issues of the communique and see exactly what we did all along the way. If you go back to February 2009, we recapped that we stopped out of every single position in the Oxford trading portfolio, and the average gain was over 28%, in a year when the market went down approximately 35%. So sticking to the stops has been good, but just as we did in 2009 and beyond, we're going to rebuild that portfolio. We're going to do it carefully. We might take a couple of positions 1 month or even maybe a little more, but we're not just going to plow into a whole lot of new positions, because that's just not conducive to making money when the markets are so volatile. So yes, we're going to take advantage of bargains, but we're still going to be careful and prudent and safe with our money, because you got to have good profits, but you have to have safety too.
All right, great. I'm glad you brought up the energy sector, because I know that you are one of your favorite bargain basement opportunities right now is in energy. And you're going to be coming out with that in the community.
It's actually not an energy producer, but it's a pipeline company.
A pipeline,
right.
Okay. I've seen different things come out from different communications from all three of you on the energy sector. I mean, Matt, I saw that you said stay away from, don't salivate too much about these high yielding energy companies. And Marc, I've seen that you find some of the yields for some of the cheap energy companies mouthwatering. So Marc, can you talk a little bit about the energy sector right now and the high yields that they're paying?
Absolutely. So I actually have a recommendation coming out in the April issue of the Oxford Income Letter for a pipeline company as well, a different one than Alec was talking about. But sky high yields. I mean, yields you wouldn't have even dreamed of 4 weeks ago for these quality companies. But the key is to find the quality companies in the sector, because as Alec described it, some of them have been bombed out. And in some cases, there's a reason for it. If oil is at $25, $30, some of these companies are going to have a real problem with their cash flows. And especially the way I'm looking at things, the dividend is so important. And so the cash flow has to support the dividend. So if these companies can't support the dividend and they have weak balance sheets, I'm not interested. So right now, especially, I mean, I'm always interested in the quality companies. I'm not looking for the garbage companies because those dividends aren't sustainable. But especially now, I'm only interested in the safest, the best balance sheets, the best cash flow, the secure cash flow that's secured by contracts. But they're out there in the energy sector, and right now, some of them are yielding double digits. So it's amazing.
Safe is a good word. So yeah, Matt, chime in because I know you've looked at a subsector of energy and said stay away.
Yeah. So for me, Dave Fessel and I, we've been covering the oil and energy sector for a very long time. We turned bearish on the sector a couple of years ago, not because we don't believe that there aren't profits to be made. We just felt that peak profits had happened in the United States. The U.S. had become the largest oil producer in the world, and it looked like we were probably going to see a repeat eventually of what we saw in 2014. So I'd forecast that I thought oil would go below $40 this year. All of a sudden, we had COVID-19. It collapsed. The oil market is oversupplied. So there's a lot of downside there. So this is all played out. Now, the companies that I talk about to avoid those high yielders are exactly what Marc just talked about. These are companies that, they don't have the cash flow to really pay their dividend. They would actually be rated F companies using Marc's Safety Net Pro. And I think when you see these collapses, there are going to be companies that are going to die because they just have way too much debt. They cannot survive this type of environment. U.S. frackers, some offshore oil drillers, those are all going to suffer. The pipeline companies, those sort of MLPs, I think those will largely be fine, but you don't want to just go out and just start gobbling up all of these yields that are 15, 20, 22% because they're not always going to be there. And a lot of the companies that I have highlighted are companies that during the last collapse, these are ones that actually cut their dividends. And just this past year, those dividends were back to where they were prior to the 2014 to 2016 collapse.
Okay, let's, Alec, we have gold as one of our crisis, it's not a crisis hedge necessarily, but it is an allocation in our asset allocation model. I mean, we have dollars surging, we have the VIX, the volatility index surging, and gold is in a confirmed bull market over the last year. So how are you feeling about members? Members are wondering if they should load up more on gold.
Well, we do have gold mining shares as 5% of our asset allocation. And one of the easiest ways to do that is with the ETF, which symbol is GDX. And it owns all of the top blue chip gold mining companies around the world. And we prefer the gold mining companies over the metal itself because gold obviously doesn't generate any earnings, doesn't pay any dividends, doesn't have any cash flow, doesn't have any earnings. So you really, you have a metal and that's it. If you own an ounce of gold 1,000,000 years from now, with everything reinvested, you'd have an ounce of gold. So we want a way to leverage that return on rising gold prices, and gold mining companies give you an opportunity to earn a bigger return than the increase in the price of gold itself. So I wouldn't overdo it. 5% is all we recommend for gold mining shares, but as a diversification, that's a good place to go right now.
Silver, would you not look at silver as a way to make money right now, not just necessarily crisis?
They have gold and silver mining shares both in that one fund, GDX.
All right, great. Marc, let's turn back to this corona crisis. The numbers are probably undoubtedly worse today as our members are viewing this session and, versus when we recorded a couple days ago. You are a biotech specialist. Are you hearing anything on the within your insiders network on what we can expect, that can get us out of this mess and save lives, whether it's from a breakthrough company, pharmaceutical, or even from an investor point of view?
Yeah, there are quite a few companies that are working on treatments. Most of these are companies that have a drug already in existence that are being tested. The FDA is being very aggressive and lenient in allowing these drugs to be tested in patients at the current time. The one thing I would say from an investment standpoint is to be very, very careful. There are companies like Gilead Sciences and their drug remdesivir, which was originally created for Ebola. It was actually never approved for Ebola, but that's what it was created for. That's starting to see some success in very early trials and early experiences with patients. But my point is that there are companies out there like Gilead, big established biotechs or pharmaceuticals that are working on this. And if you're interested in trying to play this from an investment angle, that might be a way to do it. But keep in mind, Gilead is a $22 billion a year revenue company. So even if this drug works, it's not going to necessarily move the needle that much for revenue. What I do want people to be very careful about, though, is there are a lot of companies, they're usually penny stock biotech companies that jump on the headline of the day, and I've seen them do it over and over, whether it's Ebola, whether it's Zika, whether it's the coronavirus, and the minute some health crisis happens, they're out there with a headline and their stock spikes and everybody piles in. And just be very, very careful about these little tiny companies that have no experience of ever getting a drug to market, putting out a headline whenever a crisis happens, and suddenly they're working on the cure or the vaccine of the day. So they're out there, and I really want people to avoid those companies.
What is your prediction for us getting a vaccine approved and out into the pipeline to patients?
As far as a vaccine, they're saying a year to 18 months. As far as an actual drug that can be used to treat patients, it's very difficult to say. I mean, like I said, they're starting to see some early success with remdesivir, whether that's the silver bullet or not. I mean, anecdotally, I've heard a couple of cases where it was, but doctors are also saying it's just too early to say, and whether it was the drug or that the disease had run its course. There's just not enough data out there at this point, so it's very difficult to say.
Matt, our research team, I'm going to put a chart up here. We had our research department put together kind of the length of all the bear markets in our recent history. And some of these bear markets are what we would call event-driven bear markets, meaning the event that caused them, the catalyst, was outside of the financial markets, like this bear market we're in right now. This is one of the fastest, I said they think it's the fastest bear market we've ever experienced in history. So I think it's saying that for an event-driven bear market, they usually average around 13 months or so. So what would you say to our members as far as their patience? I mean, are you expecting this to follow suit around 13 months? They can look for a recovery from the bear market recession, or what would you expect?
I would expect about 13 months. I don't think this is going to be something that's over 6 months from now, or it's going to be we're going to be back to our highs by the election. This is a very steep, damaging pullback. It's really hard to predict how long the economic impacts are going to exist. If we think of the fact that since 1854 we've had 33 recessions. Those have lasted about 6 months. We have these bear markets, like you're talking about here, these event-driven bear markets that last for about 13 months, where just a general bear market will last almost 2 years. So this is going to be a very, very, very difficult scenario, because what if everybody has to shut down? We know Vegas is shutting down, all the casinos, all the restaurants, all the airlines. Let's say Boeing, right? Boeing doesn't get a bailout. That's hundreds and hundreds of thousands of workers that are looking for some sort of employment. Now, they all can't be on the government's teat forever. So how long does this bear market last? That's very difficult. This is actually an argument, my wife and I have every single day.
That's a very intellectual argument for a couple.
Well, but yeah, but we sit there and talk about how much the bond is going to be down, how much further does it have to go, how long it will last, because there's so many questions, and that's the uncertainty that's driving the volatility in the market. I had somebody recently ask me, should I go all in? Should we start? This is the start. We start plowing money in, and as Marc and Alec has both talked about already, no. I told them, if we can get through a week without limiting down on our losses, then maybe you can start going, all right, now I can start going bigger and bigger bets. But this is something where you're going to have to pick your spots. Don't go crazy. We don't need to all be in at the bottom, at the exact bottom. Just close enough. This is, hand grenades.
Okay. Alec, you and I have been, as I mentioned, through a few crises together. And so you have experience in a time frame for recovery. Many people like to say, this time it's not different, but I feel like this time it is different. Would you agree?
It's funny you should say that because I wrote a column about that last week where I talked about the fact that even though the events that cause the market sell-off are always different, when the stock market crashed in '87, no one could even find a definitive cause. It just gapped down at the opening and never stopped. When Saddam Hussein went into Kuwait and took the oil fields, that was different. When 9/11, when they flew those planes into buildings, that was different. And when the real estate bubble collapsed and Bear Stearns and Lehman Brothers fell, that was different. So in a sense, it always, the coronavirus, obviously very different. When John Templeton famously said that the four most expensive words in the history of investing are "this time it's different," he was referring to the fact that if you respond to it differently, I mean, a child can look at the 200-year history of the stock market and you say, where would be the best buying opportunities? Here, 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 and here. It's easy to see. But what people can't wrap their heads around is there's all kinds of negative things happening during those market drops. If you took all the emotion and you took the news out of it, then it would be obvious, oh, stocks are 30% cheaper than they were a few weeks ago. It's a buy. And stocks will, a year, 2 years, 3 years from now, look like a buy at these levels, but they could also go lower first. And my suggestion to members is not to be thinking about what is the market going to do, because nobody knows the answer to that question. What they should be asking is, what is this business going to do? Because that's something you can analyze. I mean, we know things are going to be very bad for cruise lines for a long time. They're going to be very tough for airlines and hotels and restaurants. We know that there's certain sectors are going to have a very difficult time. So rather than thinking what the whole market's going to do, which no one can do, you really want to emphasize what are those areas where the company's got a sustainable competitive advantage, the valuation is cheap, the dividend is secure, the profit outlook is good, and then pull the trigger. And I'm going to be pointing out a lot of those opportunities, and I know that our members are looking for actionable information now, so I just want to point out that every stock in our 10 baggers of tomorrow portfolio are a buy right now. And I look at Novacure and Neogenomics and Myocardia in particular. Those stocks are dirt cheap, and they're all biotechs. Their earnings prospects have not changed one bit. They are truly on sale. So I can unequivocally say, you're looking to put money to work, Neogenomics, Myocardia, Novacure, great buys. Our Oxford All-Star portfolio has 6 positions, some of the best money managers in the world, including Warren Buffett and Carl Icahn and Sam Zell and others. You can own any of those stocks. They're all rated as a buy, because the only portfolio we use the trailing stops is in the Oxford trading portfolio. And that gets all the attention because those are the sexy stories and the fast moving stocks, and people love to trade them, and that's great. But there's only 3 positions left in the Oxford trading portfolio that are buys. And so go ahead and feel free to buy those. But also look at our 10 baggers of tomorrow portfolio. There's some great companies there. They're fire sale prices. And their future prospects have really not been dimmed by the coronavirus. So I think if members are looking for a place to start, that's a good area.
Okay, thanks. I actually use the term bear market recession or recessionary bear market, but I think that's silly. I mean, let's talk about the recession and the bear market. So we're not telling members we think the recession is going to last this long, so you need to wait. The market itself acts very different from the economy. So Matt, can you talk about that? Like, we know there's a coming recession, or we're in a recession, but isn't that, disconnected for an investor from when they should be going into the market or not? They don't need to wait for the recession to be over, correct?
I mean, the market is always going to overshoot to the upside and to the downside. Like I said earlier, recessions over the last, 150 plus years, almost 200 years, they've lasted about 6 months. So we know that right now, first quarter earnings, those are all going to be hurt. We can see that retail sales are down 30%. We know, like Alec mentioned, airlines, cruise lines. I mean, this is 9/11 again for those 2 industries. Energy is going to get clobbered. That's going to bleed into the second quarter. How long after that is the question. That's the economic question. The market will begin to rebound well before the recession is over, maybe even before we even recognize, like, okay, now we're in this sort of recession. Because, like I said, the market is just going to overshoot to the downside and to the upside. I mean, look at the fact that it wasn't even a month between all-time highs on the Dow and a bear market. That's how quick this situation evolved, and it's constantly evolving. I do want to say from an emotional standpoint, for investors, this is a time that you kind of have to be careful, because to me, it kind of feels like 9/11, right? So I was in the DC area at that time. You just get stuck. You're stuck in the house. You're watching the news. You're watching this news cycle over and over and over and over again, and it becomes to create this kind of anxiety that you feel like you need to do something. And as Alec pointed out, you don't need to go out and rush out. I do take some time, play some video games, try to do anything to take a break from it, take a walk, because if you're not a day trader, right, then this seems like the end of the world for you.
And I just want to add real quick, I mean, keep in mind that, the market is a forward-looking mechanism, and it will bottom before we start seeing good news. I mean, if you think back to the bottom of the Great Recession, the market bottomed in March 2009. I mean, there was not good news in March 2009 at all. And anybody who would have said, hey, this would be a great time to buy stocks would have thought you were crazy. But that's very typical market behavior. It will bottom and start moving higher before anybody is really ready to get involved. So, keep that in mind, that it is a forward-looking mechanism.
Absolutely. We were already seeing a lot of volatility entering the election cycle. So, Marc, how do you think this election cycle is going to play out this year? Can you make a prediction? I mean, how is it going to either add or subtract from the market?
That's a very tough question. If you had asked me this a month ago, I might have had a very different answer. A month ago, 2 months ago, I would have said Trump is going to be reelected. Now I would say it's a coin flip, and what that will do for the market is I honestly couldn't begin to come up with a prediction if it will affect the market, or maybe the market will predict the election, which can very often happen. If you see the market start to take off, then that might be a sign that President Trump will be reelected. If it doesn't find a bottom, that could be a sign that a Democrat will be elected.
Alec, do you have any comments?
Yeah, I would agree with Marc that, the smart money was saying just a few weeks ago that Trump was very likely to win re-election. But, he's decided to tie his own fortunes to the economy and the stock market. Now the economy's turning down and the stock market gains have evaporated. And I think he's going to be judged about how well he handled this. And there was a kind of widespread perception that the federal government sort of bungled this initially. We didn't have enough tests. They told us it was not that big a deal. Virus, wasn't that big of a killer, et cetera. But there's been a big reset, and now they're pulling out all the stops. And it remains to be seen what's going to be done and how effective it's going to be. But I think if we have a bad economy in November, it would make it tough for him. Partly because his approval numbers have never really gotten over the 50% level anyway, to win re-election based on the tough times that we're in.
Okay, thank you. I want to get to our member questions. We did receive quite a few, but we have time for I think actually a lot of them that I read, all three of you have answered very well. Thanks very much. But I would like to go to Marc. Timothy asked if you could please discuss the fall of REITs right now. What sectors of the REIT market are most concerning, and which have the best chance for future appreciation?
Well, the interesting thing about REITs is that typically when interest rates fall, that's positive for REITs because they borrow so much money. Obviously, this time REITs got hammered along with everything else, and I think that's kind of just very typical of what we're seeing in this market, that there's been a big disconnect from what is kind of normally happens and what we're seeing in the past few weeks. The valuation is totally going out the window as far as what people are willing to pay for a stock. Specifically within REITs, I mean, I think obviously mall REITs are going to be difficult. They've been hammered, and I think they're going to have a difficult time rebounding. Malls weren't in a great shape to begin with, and now that they're closed, that's going to be quite a difficult prospect for them. If I had to pick a favorite spot in REITs right now, I think it would be either apartment housing People are still going to pay their rent once they get back to work. And I think most of these apartment REITs, they're not in lower income locations. So you might have people that are a little bit more able to sustain this recession. But I think my favorite area would be actually student housing, because as long as school's in session, students need a place to live and someone's got to pay for it, whether it's the parents like me or if the government is going to step in, but somebody's got to pay for places for students to live. And there are an awful lot of kids in college right now, and they're going to go back to college, hopefully, in the next few months, certainly by the fall, we hope. So I think student housing REITs is a great spot to be in right now.
Okay, thanks. Alec, Brian asked if you could comment on all this, your trading portfolio, and if we've stopped out of some of the positions, when do you look to get back in? You know, some of them are good companies selling at a discount right now. Aren't they a good time to buy?
Right. Well, the first thing I'm going to do before I buy anything back is see how the prospects have changed. If the prospects are truly good and the profit margins are sustainable and revenue is not going to evaporate, then we may re-enter some of these positions. But I can guarantee we're not going to get back into all of them, because it makes no sense to stop out of a stock and then just get back in 10% higher or 10% lower, because we're really looking to maximize our returns with the companies that have the best chance of beating the market averages. So I'm going to be analyzing what those companies are. But I can tell you right now, as I mentioned with these biotech stocks, I want companies that if they're not going to they're not only going to not be hurt, but that they actually will profit in the weeks ahead, because they're in food or consumer products or medical care or something that they're bound to benefit. So I would tell all members, don't think that just because we liked those stocks in the past that we're definitely going to buy them back. We may buy some of them back, but we're certainly not going to buy all of them back. And that was not the idea behind the stops, is get out and then get back in. You know, sometimes you get knocked out because the fundamentals have changed, and the fundamentals have indeed changed for many companies. So I'm going to take it on a case-by-case basis.
Okay, but what about your gone fishing portfolio, where you don't apply trailing stops? It's a rebalancing type thing. What would you?
Right.
When do people rebalance with this kind of chaos?
Okay, well, it's not a bad time to rebalance if you haven't rebalanced into stocks in a long time. Rebalance bonds and into stocks. You should ordinarily balance it once a year. But again, the gone fishing portfolio, which is 10 Vanguard index funds that represent 10 different asset classes, is a long-term asset allocation portfolio. We don't use trailing stops because, as you mentioned, our sell discipline is to rebalance once a year. And that's one of the beauties of our Oxford investment system. If we do get a V-shaped recovery, I mean, no one's betting on this. Everyone's thinking best case is a U-shaped recovery and maybe an L-shaped recovery where we have quite a while. But if we did get it's been a very severe bounce back, and if the federal government came up with a plan and people and investors got behind it, then we could see a pretty quick rebound. And in that case, again, you've got all those positions in the Oxford All-Star portfolio we still have, all those positions in the 10 baggers of tomorrow portfolio, all those positions in the gone fishing portfolio. So while we're rebuilding our Oxford trading portfolio, we have these other portfolios where you're still fully in the game. So, and if you're not in the game yet, make sure, again, you can always add to those positions now. You can do the gone fishing portfolio with ETFs, or you can do it through Vanguard mutual funds. But the idea is not to be sitting in cash. You don't want to have a ton of cash waiting for the right spot to get in. The idea is that you've got some money that's invested in various things right now with no stops, and then we're going to re-enter a few of the stocks that we stopped out of that we liked, and new companies that we haven't owned before.
Right, you say that, but how many months should people have cash reserves just to live on? You were always saying that you should.
I can assure you that starting immediately, but within, I'd say, less than 6 months, we'll have all that cash redeployed. So it'll be a gradual process. You know, a month from now, we might be a quarter reinvested, 2.5 months out, half reinvested, 6 months out, fully reinvested. But remember, it's not just that the stocks are going to be higher a month or two from now. They could very well be lower. We just don't know. So we're going to pick our spots and buy great companies at fabulous prices and be perfectly positioned to take advantage of the next leg up whenever it comes.
Yeah, I'll pose this question to Marc, because Marc is a big promoter of financial literacy and helping especially younger people decide how much they should have in the market versus how much they need to live on. So I guess what I'm asking is, how does a person decide how much they shouldn't put money into the market that they're going to need in the next month, let's say.
Yeah, shocks or not, the kind of the standard advice is to have 6 months worth of living expenses in cash or something very liquid, certainly not at risk. And what I typically recommend to people, especially retirees or people who are getting close to retirement, is any money that you're going to need within 3 years to pay bills should not be in the market because of events like we just saw. None of us time the market. You never know what's going to happen. And so if you need that cash to pay bills, pay healthcare bills, pay the mortgage, the rent, whatever, that money should not be at risk. So you can have it in some safer things. You can have it in some safe bonds, some very safe corporates, or even treasuries. You're not going to get great yield on them, but at least it's safe. And so I would not put any capital that you need within 3 years into stocks. That being said, if you have a longer time horizon, then I think you can be aggressive and have money in the market and have a considerable amount of your portfolio in the market. And obviously for everybody, it's going to be a little bit different based on their risk tolerance. But I would say certainly that 3 years is critical because you just never know what's going to happen. You hit a bear market and it can take, as we said, it can take a year and a half, 2 or 3 years for it to come back.
Okay. And remember, Steve asked you, Marc, about bonds. Are there safe bonds right out there right now, discount prices that you're going to be recommending or should recommend?
Absolutely. Bonds pretty much did what they're supposed to do if they were in the safe companies during this market rout. They really didn't move that much. I'm actually writing an article for Wealthy Retirement right now. When I looked in my personal portfolio, when I look at the Oxford Income Letters blue chip bond portfolio, those bonds did not move very much. So they did what they're supposed to do. They provided ballast for the portfolio. So of course they got hit a little bit, and certain sectors got hit a little bit more than others. So I'm not necessarily looking to buy an energy bond at this point because those got really smashed. But there are plenty of industries and even industries that did get hit in this stock market rout, their bonds really didn't. So there are plenty of bonds out there that are maybe a little bit below par that are pretty good values, and we're going to be recommending them both in the Oxford Income Letter and the Oxford Bond Advantage. But the bonds, for the most part, did exactly what they were supposed to do in this market.
Okay. Matt, last question for you. You just must be buying because you've come out with a new portfolio. Will you call it your new crash-proof portfolio? Can you explain a little bit about that?
This is actually a strategy I used during the 2018 correction. This is all about exactly what Alec and Marc kind of alluded to. This is targeting companies where the fundamentals have changed dramatically for these companies. We're talking about companies where falling revenue, falling earnings, where the analysts are getting more bearish, and their entire outlook has completely changed because of the current economic situation that we're in. This is about buying puts on these companies, not selling puts, and not shorting those stocks. And in the past, this is done, like I said, just did excellent. During the 2018 correction, we scored a bunch of triple-digit gains by targeting just companies that are underperforming. So I think there are a lot of industries right now, even though they've been hammered to levels that we haven't seen in years. And in some of these cases, we haven't seen some of these stocks down at these prices in over a decade or more. I still think there is more room to fall. So this system, which I'm introducing in this crash-proof portfolio and Trailblazer Pro, that's what it's going to be targeting. It's going to be targeting all of these really underperforming companies over the next several months.
All right. Thank you so much. I just have one more question for each of you. Any recommendations about how our members can keep calm right now and get through this? Maybe how you're doing it yourself personally.
Well, I'll say for my sake that when I speak at conferences, I always try to emphasize that successful investing is not about following the right predictions. It's about following the right principles. The principles of investment are well understood. Warren Buffett knows them. John Templeton knew them. Peter Lynch knows them. Times like these always present buying opportunities. And so you don't want to be so fearful that you don't, A, stick with the program, and B, look for opportunities. And we're going to be pointing those opportunities out. But you should be in that frame of mind that you're being opportunistic, not fearful, because as Warren Buffett famously said, you want to be greedy when other people are fearful and fearful when other people are greedy. So we're definitely in a fearful stage, and that means opportunities are out there.
Marc, how are you staying calm?
Well, there's two things. One, I have a very clear memory of 2008, 2009. And, I saw things come back, even though it felt like they never would. So in fact, actually today I recommended a position in Oxford Income Letter. Back in 2008, bank stock preferreds just fell off a cliff, like the banks were going out of business, which it appeared that at the time they were. They eventually came back. Today, I actually recommended getting back into a preferred of a mortgage REIT that the preferred stock got absolutely hammered. At the time of the recommendation, it was yielding 30%. So if this company didn't go out of business, investors had a chance to make just a ridiculous amount of money. So I recommended that. So just remembering the lessons from 2008, and at the very beginning of this broadcast, you said, is this a once in a lifetime opportunity? And I would say no, because we saw this in 2008, and chances are we'll see this again in, could be anywhere 10, 15, 20 years, maybe sooner. So these opportunities do present themselves, and it's important to take advantage. And I'll just leave you with a quote that I recently discovered that I love by Shelby Cullum Davis. And it's, you make your money in bear markets, you just don't know it at the time. So I think that really, really explains why you should be investing when it really is very, very difficult to do so.
Mm-hmm. Matt, how are you staying calm or helping your subscribers stay calm?
Well, always my mantra is don't panic. This is times where, like I said, I'm a crisis investor. We're looking for depreciated assets. This is the time where I'm out hunting for opportunities. I don't need to go rushing back in. Don't need to get over leveraged that way. But it's just knowing that, yes, there are collapses. Yes, we knew that this was eventually going to happen. I thought, 2020 was going to be a difficult year anyway with the election volatility. I did not think COVID-19 would kill the bull market, but that is what has happened. And so now you're just kind of preparing for how you're going to profit on the backside of this. And this is slowly picking your spots, slowly identifying opportunities. I'll use my quote that I really like, which is, everybody has a plan until they get punched in the mouth. Well, everybody got punched in the mouth. So now you have to stick to your plan. Don't panic. Don't bite somebody's ear off. Just stick to your guns.
We all get that reference.
Well, thank you. I mean, for me, I'm an optimist by heart, and practicing patience, and I think that's helped me as a CEO these past decades with the Oxford Club. And so I'm going to keep reminding myself to stay optimistic and patient. And also, I'm looking at the numbers. I'm looking at, as we test more, we're seeing more people infected, but we're also seeing the death rate go down. So I'm looking at the math, and that's giving me some comfort. I think, I believe in our fortitude to get all the technology out, get all the support out to the hospitals. I think we're going to make things happen, and we're going to see the numbers go in our favor. That's my prediction. But I think we're going to need patience until then, and fortitude. So anyway, thank you all very much. Alec Green, Chief Investment Strategist of the Club and editor of our Oxford Club Communique. Marc Lichtenfeld, editor of our Oxford Income Letter. Matthew Carr, editor of Strategic Trends. Thank you so much for being with me today. And I'm really glad that we have you to help guide us in these turbulent times. You're a wonderful team, you and your co-editors. Thanks so much for being with me this Sunday.
Happy to be here, and our members are going to be just fine.
Yeah.
Okay. Take care. Be safe.
You too.
Right.